You're welcome to this session. My name is Ssebuyungo Wilber Kivekayunga, a lecturer at Nkumba University. And this lecture, we are going to focus on finance accounting and specifically looking at using the finance principles while we are actually doing accounting. In this lecture, we shall also look at the accounting equation, and then after looking at the accounting equation, we shall see how it is applied in business practice. So we're going to be focusing on finance accounting. And in finance accounting, you'll see that we looked at a principle which is also called the principle of duality, and that this principle of duality comes from the word draw, which also means double. So wherever the debit occurs, thus even the credit has got to occur. So we say debit and credit, things equivalently, what increases somewhere, possibly the very equal quantity, has also decreased somewhere. So wherever there is receiving, there is giving, and wherever there is giving, there is also receiving. So the principle of duality states that for every transaction, there is a debit and also the credit occurring at the very time. So it means that two accounts get affected at the very time, and thus that is very important in accounting, where we see whenever we want to increase assets increase by debiting them. So the word debit in assets is used to mean an increase in the asset account. But crediting any asset, it also implies a reduction on assets. Possibly those assets are being used up, and therefore whenever you credit the asset, and then you have to debit another account if they are used up and you have used them up. So you credit the asset and then you debit the expense. So we shall see how we deal with the other side of liabilities when we look at the accounting equation. So here we go. We are looking at the accounting equation, and at the same time using the principles of accounting which we looked at in our previous session. So our accounting equation, this is how the accounting equation flows. That when we have assets in the business, where we have assets in a business, which assets could be fixed assets or current assets, and we are looking at assets generally. So assets can be physical assets or intangible assets, but they must be present, they must be available, so that we account them as assets, and we should have acquired them. So we said, and how did you acquire these assets? You got these assets, what was the source? What resources did you use to acquire these assets? And one of the things we look at here, we look at two things, but one of them we could say, did you get these assets from liabilities? Did you acquire a loan from some institutions or an individual? Did you get a liability? Do you have a liability? For you to be to have a car in your home, you should declare where you got it. Did you borrow money, or did you actually work somewhere, received a salary and used it as the capital, your own capital, to buy that car? So we can trace assets by saying that the total assets are equivalent to liabilities that you got, and the equity which we call owner's equity is exactly what capital you got without liability. So when you get money which is not liability and you invest it in a business, then we say that that is the owner's equity. So owner's equity can be share capital from the shareholders, or directors' capital inputs to those companies where the directors are the same as what? As the shareholders. So when they get money and invest into the institution or this corporation, the company, then that we call it owner's equity. However, owner's equity is a totality of even the profit that the business generates itself, what we call retained earnings, or accumulating profits. So then it means that for us to have assets in the institution, we have either had equity or owner's equity, which is capital inputs and also internally generated profits, or liabilities where we have gone for a loan. So for that case, you will see that liabilities can arise from loans or creditors, or where the business has a debt. So the summary of what we call liability is, the word is a debt. Liability is a debt, and this debt can arise from acquiring a loan facility or having creditors. You're using assets on credit. You got assets on credit. You bought a car on credit. You bought furniture on credit, motor vehicle. So you bought land on credit. So whatever you get on credit, it is registered in accounts as a liability. And then, so what we call assets, we've looked at them as fixed assets and current assets. And then we'll see that we could have fixed assets and then current assets physically, which could be things and money itself, even money. That's why we say cash at bank and cash at hand are current assets. Yet even cash with other people or other institutions that we can claim and actually recover, we call debtors, is also a current asset. Then we also have stock as a current asset. You could also have prepayments or advance payments as also current assets. Then fixed assets are many. You looked at land, motor vehicle, you looked at furniture, computer resources, land, computer resources, and other fixed assets. You fix them, so you have them, such as machinery, and you're going to use them in the process of production or service delivery without necessarily trading them. So that's why we call them fixed assets. Others call them long-term assets. Now, that is the accounting equation, which says that all assets are should be equivalent to all the liabilities plus all the owner's equity. And thus the owner's equity is the right of the owner, and thus the owner has the right of equity, of owning the equity. That's the what the owner actually has in relation to the business. Now here we want to look at what we call a business transaction. We call a business transaction actually a transaction when it has the debit and the credit. So where we have quantities, and it is therefore quantifiable in terms of amounts of money or costs involved. We should also know the who is involved, and also we should know the particular accounts that are being affected by a transaction. So transactions are characterized by amounts. So We can't say Jonah bought land and then we end there and say that is actually a transaction. Yes, bought land, but that is an incomplete transaction. We would like to know bought land on such a day and the amounting to some amount. The amounts have got to be declared so that we know that that is exactly what Jonah did. So now, what is a transaction? That is what you need to look at. A transaction is an economic event or a condition that directly changes an entity's condition. So it could also directly affect its results of operations. So how it has been operating changes because it has transacted. So there must be a change in the institutional operations and the state of affairs of the institution. If there is no change, then that is not a transaction. And then we have an example here of a transaction where we see that on November 1st, 2023, Wilber SK, that one begins a business that will be known as Wilber's Barbecue Cafe. So this is a cafe that Wilber SK has begun. Can we say that this is a transaction? Is this really a transaction? So yes, we are able to say that this is not a transaction because we do not have any amount on the transaction. We don't know, we know the date, but we don't know how much he spent on opening up this Wilber's Barbecue Cafe. But now if we knew how much it cost him to register Wilber's Barbecue Cafe and the nitty-gritties, those costs that are involved, then we can say let us count that as the owner's equity. Now, we can also take an example that Wilber SK, who is the proprietor that initiated Wilber's Barbecue Cafe, is depositing $25 in a bank account in the names of Wilber's Barbecue Cafe. So here we are seeing that the proprietor here of Wilber's Barbecue Cafe is depositing 25,000 shillings. These are $25,000 on a bank account. So they are dollars. So we ask, what is that? What does that imply in terms of assets and equity and liability? Can I say that the $25,000 are going? Yes, they are being deposited on the bank account. So that money has gone on the bank account, which bank account is registered in the names of Wilber's Barbecue Cafe. So can we say that this bank account that is now having the 25,000 US dollars can we say that is a liability there? Can we say that is equity? Can we say that is an asset? So how do we treat that in accounting terms? So now you will see that when cash is brought in by the owner, we call that the owner's equity, which other people call capital input. And then it comes, so it means that it is going to come in. So we are going to make sure that we increase the owner's equity by $25,000 US dollars. But we are also going to increase the account in the bank by the very amount in terms of debiting and crediting. Maybe to just draw you a little back here in the accounting equation, we see that when assets are increasing, when we are looking at debits and credits, when we are to increase assets, we debit the asset. If we are to reduce the assets or decrease assets, we credit the asset. So we credit the asset. However, when it comes to liabilities and equity, it is another case. For you to increase the liability, you've got to credit it. You credit the liability. But to reduce the liability, you debit the liability. We use the signs negative to mean credit and the positive to mean debit. But whenever we debit a liability, it means that we are reducing the liability. It is like a payment of the liability. Wherever we are crediting the liability, because liabilities are already negative, whenever we credit them, they increase in the negative. So they keep on accumulating negative. So for us to get a loan, we say we credit the liability, and then that money we have got, we deposit it on the bank account, or we can even bring it to cash at hand. So we say in that case we debit the asset called cash. So this exactly is what you see here, that when Wilber SK deposits $25,000 on the bank account in the names of Wilber's Barbecue Cafe, yeah, that money has gone on the bank account, but we shall say we are going to credit the what? We are going to credit equity, so that owner's equity is going to increase by crediting it. And then also cash, which is cash at bank, is also going to increase by the US dollars, 25,000 US dollars. So we are able to see here the accounts that are being affected. That's owner's equity has increased, and also the assets at the bank are also increasing, because we see cash at bank is an asset. So cash is increasing and owner's equity is increasing. But we are able to see that cash is coming from the owner's equity as capital investment, then it is entering the account. So you credit the bank, you credit owner's equity and debiting the cash at bank. That's the summary of that transaction. Now let us also look at another case where Wilber's Barbecue Cafe exchanged 20,000 US dollars for land. So now Wilber's Barbecue Cafe, that has in the previous transaction received the $25,000, is now going to buy land. You see, it is using an asset called cash at bank, current asset called cash at bank, to purchase a fixed asset called land. Okay, so there it means that our cash at bank will have to reduce somehow, yes, by the 20,000 US dollars. So we are going to see this transaction. What is it affecting? We need to look at which accounts are affected in this transaction. Wilber's Barbecue Cafe exchanged 20,000 US dollars for land. Okay, so now we start to see which accounts. We have an account here which is called land, which is a fixed asset. and another account where money which is going to buy land is coming from which account? Good, that it is coming from the bank account. So we are going to credit the bank account by 20,000 shillings and debit another asset account called land by 20,000 shillings. Will owner's equity be affected in this transaction? So we say no, it is not going to be affected. Are the liabilities going to be affected? No, they are not going to be affected because we are buying land with cash. If we are buying land on credit, then the liability would arise because of buying land. But here we are just going to withdraw money from the bank, credit the bank, and buy land, debit land. So that's what you're seeing here, where owner's equity is not affected, the capital is not affected, but what is being affected is the cash and the what? And the land. So we go to the bank account which had $25,000. Credit, meaning this is a negative. This negative means credit. In other ways, we could even put it in bracket. When you will see figures are in bracket in accounting, it means that figure is negative. So we credit cash by $20,000 and debit land here by the very amount, the $20,000. If we were to capture dates, the credit and the debit would be occurring on the same date. So then, if we are to balance these accounts, we see that the bank account which had $25,000 is reduced by the $20,000 that is going to buy land, and therefore the bank account will reflect a balance of 5,000. And then here we see that land has received $20,000. This land is still with you, you have not sold it. If you sell part of it, then it means you're going to credit that land amount of that on that land, and then if you take that money to cash at hand, you debit cash at hand. If you take that money to the bank, you credit the land account and debit the bank. That transaction means a sale of land. So now you could see, we can also look at another scenario. While during the month, Wilber's Barbecue purchased supplies for $1,350. So during that month, you see that in the accounts of Wilber's Barbecue, there is only $5,000 remaining. The other money was used up to pay the landlord and acquired, and we used that money to acquire land. So we only at cash at bank, we remained with $5,000. So this means that during the month, Wilber's Barbecue Cafe purchased supplies for $1,350 and agreed to pay the supplier in the near future. We can now see that Wilber's Barbecue is borrowing money. Is buying goods on credit, which means that is Wilber's Barbecue is acquiring goods on credit, so then it is increasing in liability. Wherever we say that we are going to pay in the future, and we have acquired that asset or those supplies, it means we have acquired those goods on credit, and therefore we are having a liability. So in accounting language, we have what we call accounts payable. Accounts payable is an account on which all goods purchased on credit are recorded. And then there is another account called accounts receivable. The accounts receivable is an account on which all goods sold on credit are recorded. So for this case, if we purchase supplies on credit, so we are going to have a liability because we are purchasing on credit, and this liability will be recorded by registering them in accounts payable. So we shall increase the accounts payable by the 1,350, and also have to increase the account for supplies, which is an asset, by the 1,350. So a credit in the accounts payable is by 1,350. Then you debit the supplies by 1,350. However, wherever we write a figure in accounts payable, we don't record their negatives, because all liabilities and equity accounts are apparently inside there are programmed to be negative. That wherever you credit them, they increase. Wherever you debit on them, they actually decrease. So that one we don't need to keep putting their negative in what? In liabilities. But wherever we credit liability accounts, those liability accounts will increase. That's why we use a plus sign there. But they will be increasing, meaning you have more liability. Wherever we debit the liability accounts, like if we were to debit accounts payable by some money, it will be decreasing by that money we are debiting there. So for this case, we've been looking at the purchasing of supplies on credit, where we had to increase the accounts payable by 1,350 and also increase the supplies account by 1,350. So because we have bought these goods on credit, so it does not affect cash. It does not affect cash. But we have increased by the supplies and also the liability due to accounts payables increasing by 1,350 has been incurred. Cash can only be affected if we try to pay this what? To pay for these supplies by crediting cash and debiting the accounts payable. Then the accounts payable will reduce. Remember, debiting accounts payable, which is a liability account, means a reduction on that account, because it is a liability account. Okay. Now, for this situation, I could use a situation where I can now look at another situation. If, for example, the customers of Wilber's Barbecue provided services if Wilber's Barbecue provided services to customers, earning fees of 7 $3,500 US and received the amount in cash. Here we are selling services and receiving cash from the customer. So when we receive cash from the customer, that means that we have sold goods. So we shall debit the cash, because cash is going to increase. And that cash could be, if it is at bank, paid at bank, the bank account will increase. You debit the bank account and credit the fees account, which is sales. Sales, yeah. You credit sales. Whenever you credit sales, they increase what we call the capital account. Wherever you make a sale, any sale increases the equity account. Any expense decreases the equity account. Okay, that's what you need to note. So any sale, you increase the equity account. What is a benefit to the company? It is a gain. But any expense decreases the equity account, because it is like you are losing out of the business. That's why we came here and credited the capital account. Crediting the capital account means it has increased. And then we also debited the cash. We increased the cash by the very amounts of $7,500 US. In this situation, Wilber's barbecue is making the following expenses. Wages is $2,125 US. Rent $800. This is $800,000 US. Utilities, this is $450 US. And the miscellaneous account is having this is $275 US. So we realize that all these are expenses. And what do expenses do? Expenses reduce cash, okay? Meaning they credit cash, whether cash at hand or cash at bank, depending on where the cash is. And wherever we credit cash and we are making expenses, we debit the expense account. Specifically, for example, wages here, we debit the wages account. For example, rent, we debit the rent account. Then utilities, we debit the utilities account. But in terms of owner's equity, okay, in terms of the owner's equity, it means that because it is an expense, it is a reduction on owner's equity. Every time we spend money, owner's equity is getting affected. Owner's capital inputs get affected because of the expenses. That's why owners are always very inquisitive, looking at how organizations are spending and how managers are utilizing finances, finance managers, to reduce expenses, because the more expenses are made, the more the equity or capital gets depleted. And thus, they make sure that organizations make more sales. They set up budgets to regulate expenses to protect owners' equity. So all expenses keep on reducing owners' equity. That's why you see that cash, this is a batch what? Credit. Yeah, the 300, this 3,650, we are crediting a batch together at once, crediting at once by crediting 3,650. a totality or a summation. We are adding together wages. We have also added their rent, utilities, and the miscellaneous. So that is very important. So you can now see the accounts balances here. Then if we have another transaction that says Wilber's Barbecue paid $950 US to creditors during the month, then we ask, who is the creditor? That is a creditor who had supplies. Okay, so wherever we pay the creditor, we reduce cash, but also we reduce the what? The creditor's balance. So credit cash, debit the accounts payable account. We see that wherever we debit the accounts payable account, the other account reduces and goes down. Okay, and then wherever we credit, we reduce cash, that cash also reduces and also goes down. You're going to do this, which shows at the end of the month, the cost of supplies on hand is $550 US. So the supplies were used. So now, if we say at the end of the month, so we are remaining with 550 supplies. Okay, meaning that the 1,000 here 1,350, we have used them. They were 1,350, but at the end of the month we are remaining with the stock of 550 US dollars. It means that we have used up what? We have used up 800 US dollars. So this implies that we are going to, wherever we use up materials. For example, you have made an advance payment of rent of 3 months and the month has ended, you go and credit the asset which was a debtor and spend that money for that month on rent. So you credit the debtor who had that money and debit the expense called the rent. Similarly to even when we use up stock items, we've stocked items and we have used them up, so we have consumed them, we credit the supplies account and debit the expense because we have used up those items. So at the end of the month, that's how the accounts will look like. So thank you for attending this lecture, and I would like you to review and do more practice on this, and then we shall have more corresponding questions for your practice to really learn how to deal with asset accounts, where we've said that asset accounts increase by debiting them and also decrease by crediting them. Yet liability and equity accounts increase by crediting them and decrease by debiting them. So that is very important, so that we can see how to deal with accounts. However, when we are transferring money from, we're getting a liability, we're getting a loan, So it means that we are going to credit the loan account, and then we bring that money on a bank account, we debit the bank account. Or if we bring it to cash at hand, we debit cash at hand. So when we get that money from our bank to buy anything, either it is an asset, any item, then it means that we are going to credit the bank account and debit that item account. So thank you. My name is Wilber Ssebuyungo Kivekayunga. I would like us to be following up here piece by piece, and then you'll also look at the principles of accounting, review them, and then afterwards you come up and look at transactions, how to deal with transactions when it comes to debiting and crediting. And then later on, when we've done that, we shall see how to develop financial statements and then interpret the financial statements, and then we shall be able to continue from there. Thank you, and have a nice time.